Hello, hello. I see someone has joined us, and we have a few others we're waiting on. My apologies for the delayed start today. As you can imagine, end of the year, beginning of the year, all the things, everything's kind of jumbled. So I appreciate everyone coming back a little bit after our original start date and or start time and or watching the replay if you're finding us on the replay. Thank you very much either way. We're going to give just one more minute for everyone to join, especially since there was a change up in the timing. But I hope everyone had an amazing holiday season, whether or not or whatever you celebrate. Just having that time to kind of decompress at the end of the year is, as I get older, is becoming more and more and more priceless to me. So I can imagine, hopefully everyone was the same and got to get some good quality family and friends time in, eat some good food, getting back on track, hopefully for business and personal life stuff. And here we are with our first mini masterclass of 2026. Very exciting. And we are going to talk today about some potential change in tax strategies that you can implement in your business right now. Some of them you may not be able to use in 2025 or for 2025, but knowing about them now can help you strategize for 2026 and talk to somebody. So I'm going to preface all of this by saying, I personally am not a tax professional. I happen to know a lot of really great tax professionals, and of course, we deal with our clients' books, and we know strategy, and we know how to identify tax help when we can. But I encourage you all to take this information and anything else you may be considering reviewing, knowing about, hearing about to a tax professional and have a sit down conversation. Unfortunately, now is probably too late to do much about 2025 in for tax planning because a lot of times it's dependent on you having have spent the money out of your bank account by the end of the year. But that doesn't mean there's no chance of implementing tax strategy for 25. And even if there was, having that conversation and knowing where you want to go in 2026 up front is going to be so helpful. It's going to help you stay on budget. It's going to help you pivot and do things you may not have thought about otherwise. It's going to help your tax professional understand what your goals are, where you want to go, and how they can help you. And hopefully, you have a tax professional that is doing tax planning and strategy, not just tax preparation and filing. Now, if you don't know if yours does or doesn't, simply ask, do you do tax planning? If they say, no, we don't, now you know you can maybe go see someone else that specializes in tax planning. A tax planning professional and a tax preparation professional can be two completely separate people. It's part of your financial team. They do not need to be one and the same. They may have some crossover with what they need to talk to each other about, but bottom line, you want to talk tax planning and tax strategy, not just tax preparation. I'm going to go over just a few of the more common or most common strategies that you can implement, hopefully either for 25 and or 26, if not at least just for 26. And I'm going to start with one that kind of seems the most simple, but actually people get, missed deductions all the time for not taking advantage, and that is the home office deductions. So as a business, if you have a brick and mortar, or if you have even a co-op space, or if you have some place that your business takes, um, is the office, is the main operating location of as an office, you can also get credit for having your home office when you go back at home. Now, this doesn't apply if you work remotely full-time from your home and you don't have any other locations that you work from. So this would be only be for people who have both. But home office deductions do allow you to take a portion of your rent or your mortgage interest and write those off every single month from as a business expense. It also allows you to take a portion of your utilities. It takes a portion of any kind of insurance or things that you pay for the house, any kind of maintenance that you might do to the room in which your home office is, or any kind of remodel or rebuild, as long as you have explicit documentation that that is for the room in which you provide this service or the product from, you can write that off. And it's also increasing the value of your house, so you're kind of getting to double dip there. And all of the supplies you might buy for your home office are 100% deductible, not just a portion of those. So a very simple rule of thumb for your home office deduction is to take the entire square footage of your house. Let's just use round numbers. We're going to use 10 by 10 or 1,000 square feet, sorry, 100 by 100. And we're going to say, okay, the room that I actually dedicate, and it has to be a dedicated room. It can't be like, oh, I'll use the coffee table today, and then I use my bedroom tomorrow, and then I just use the kitchen counter sometimes, or I sit on the couch and work. And so it's 100% of my house. Can't be like that. It has to be dedicated space. You're going to take whatever the square footage of that dedicated space is divided by your total square footage, and that will give you the percentage of your home that is for your business purposes. So in my case, if my home is 1,000 square feet and my room is 100 square feet, that means I can write off 10% for my home office deductions. In fact, there's actually, if you're using QuickBooks Online, there's actually a dedicated area on the P&L if you set up the chart of accounts appropriately that separates out home office deductions and expenses as well as vehicle deductions and expenses so that you can see clearly and take the write-off, but it also shows because of where they land at the very bottom that they are not what is considered a normal and ordinary expense for your business. What that would mean is that your business can't run without it, which would be false. Your business can run without your home office if you're utilizing this correctly. It just happens to be something else you can spend money on and write that money off. So proper recording of the home office would be really for your business to reimburse your personal. You do not want to start commingling your personal and business funds through the same business account. What you really want to do is reimburse yourself by writing a check or transferring or whatever it is, or paying a bill that you submit to the business back for those home office expenses at that 10% rate or at that percentage that you're allowed to write off. So that's the proper way to record it. Of course, this is all a lot of information really fast, so feel free to reach out but if you need help with that. But that is one tax strategy that could allow you to take advantage of some additional write-offs that you may or may not be doing now. In addition to mileage, if you are driving around for your business, going to the post office, going to the bank, going to see clients, going to buy supplies from a supplier, going to meetings on location with clients, if you're traveling for business events like conferences and you're driving to the conference, your mileage is also a write-off for those things. And I'll tell you, mileage is one of the highest write-offs that you can get really for, the per unit amount. And I haven't seen 2026's rate yet, but the federal rate for 2025 was 70 cents per mile. So it can add up pretty fast. And there is an actual tracker on the QuickBooks Online app that can sit right on your phone, and it follows you wherever you go in the background, and then you're just swiping whether or not it's business or it's personal. There's other apps out there. We suggest Mile IQ. It's a very good app, and it's same. It runs in the background of your phone, and you're swiping right or left for business or personal. In both cases, you're seeing your deductions rack up all year long. This amount is not going to sit on your books anywhere. You're not going to see that like adding up anywhere. All you're going to see is an end of the year report that says, hey, here's all the business miles that you drove, and here's your equivalent write-off. Now, that's important to understand. You can't just say, I drove 30,000 miles this year and 27,000 of it was business. You really need to show what was business, and what was personal. And your tax preparer will be asking you, what was your total mileage and what was your business mileage? So you need to be prepared with both numbers and the backup to those numbers, because just guesstimating, not going to fly in an audit. So that's why the app trackers are so handy, because you're just swiping and that it's doing all the work for you. And then it has dates, times, mileages, all that recorded. The other thing you can do is write it down, of course. If you haven't written it down all year and you want to try to take advantage of some of this deduction, you can go through your calendar, figure out map locations in a GPS mode or something from point A to point B for the things that you have documentation for to prove they were business events, and figure it out. I've had people spend hours at the end of the year figuring out their calendar mileage just so that they can take advantage. Always is worth it. It's usually always thousands of dollars that you're going to have a write-off for. So it would be worth it. But I suggest using an app of some kind because it will save you a lot of time. All that is also applicable if you're an S Corp officer and you have, so that would be a sole proprietor, I always get that one, single member LLC. But if you are an S Corp elect or an S Corp proper, you can also take these home office deductions. You can also reimburse yourself for mileage. You can also have paybacks that you give yourself, allowances for personal money that you spend for your business. Because again, we don't want to commingle, especially once you get into the corporate mode. Commingling should not be an option for you, but I know in reality, people do it. The best course of action if you're an S Corp or S Corp elect is to make sure that your accountable plan is in place. The accountable plan is going to be basically a bylaw of how you're going to get reimbursed from your corporation for expenses that you put on your own personal money. This also makes sure that you can write them off as a taxable reduction of your taxable liability. And it also ensures that when you do, it doesn't count as distributions to you back from the business, which all goes into your final K1 and onto your personal taxes. You're not going to pay taxes on this money that you're paying yourself back, and you're going to be able to write it off, but you have to have an accountable plan in place. The accountable plan, if you don't know if you have one or not, you probably don't have one, because it is a form you have to fill out and you have to go through and answer questions about what types of expenses might you be paying yourself back for, what's an allowable amount. If there's multiple officers, there has to be one for each officer involved. And those are things like your home office expenses, your mileage, and any other personal spending you might do on behalf of the business. So very important that you're following all the compliance side of things, as well as so that you, when you spend this money and pay yourself back, it all tracks back appropriately. So that's one tax strategy that I do see a lot of people not taking advantage of, especially when they're an S Corp and they don't think that they can do that anymore. The next I want to talk about is the Augusta Rule. This is one of my very favorite tax strategies, which is why I chose it for today, because it is also something I see very, very few people taking advantage of, and it's such a great tool for you. So the Augusta Rule allows you, human being person, not corporate officer and not corporation, but you person, to rent your house to your business up to 14 days a year, tax-free. And there's two sides of that. So I'm going to say, for example, my company, I want to do a quarterly planning retreat, or I want to do a Christmas party, or I want to do a company sponsored event for the community where everybody can come and we can, like a networking event or anything. It's any kind of business related function that you would normally go rent a location to perform this function at. Instead, you use your home for that function, and you're able to write off that event from your business, which then lowers your taxable liability. And then you as the person, as the landlord, as the whatever you want to call it of the event, do not pay income tax on the rental income from that event. So let's break that down in a workshop or planning meeting scenario. I'm going to want to do a planning meeting with my team. Your team can be one person. It's your team. But I want to do a planning event with my team. And I'm going to go to the local hotel that I could potentially have this planning meeting in. So I would either be saying I want to rent a suite and put us up in a suite for the night or 2 nights for this planning meeting, or I need to rent the banquet room, or I need to rent the ballroom that has the catering option, whatever it would look like for you. You're going to find out what that costs from a local and maybe even a couple local places. That will help you determine what a reasonable amount of money, because it has to be reasonable, would be for you to host that event outside of your business location normally. You really want to document. Document, document, document. Go overboard on the documentation, especially with tax strategies like these that are a little outside the box. Very legal, very ethical, just outside the box. You have to document. So you're going to document who you called, what their quotes were. You might even go in and get the quote from them directly, or print the email out that they quoted you in and write on it, quarterly planning session 2026 or Q1 of 2026, right? That's your documentation of reasonable. Now, what if they required you to cater from their location? A lot of places do. They require you to use their food or their services when you rent their building. If that is a requirement, you add that in. They required us, if I want to provide lunch, it's another however many hundreds of dollars for the day, right? And you add that into your quote. Now you have any kind of parking fees you might have to pay, any expenses related with this, find out what they are. Instead, have that same planning meeting at your home. Pay yourself from your business the exact amount of money that you would have had to pay to have this meeting elsewhere. Your business now has a 100% tax lowering of their tax liability, a write-off of 100%, and you have tax-free income from this event. So you're not paying taxes, the money is staying in your pocket, and you're reducing your taxable liability on your K1 at the same time. Beautiful plan. I love the Augusta rule. There is a cap of 14 days per year. So you need to document each and every individual day that you do this in order to make sure you don't go past 14 days. But there's not a cap necessarily on the amount, as long as reasonable can be proved. And what I mean by that is it reasonable that you go rent a $10,000 a night suite somewhere for this person or this one-time event? Probably not reasonable. Therefore, you're not going to want to do that and pay yourself that, right? It has to be reasonable. So that's the Augusta rule. Talk to your tax professional or strategist about how to implement that best, so there's no kind of red flaggy triggers. But man, I have seen people really do well with the Augusta rule. The next is if you are a large wage earner, high wage earner, and you're making over $250,000 in a year, there are investment strategies that actually put your tax dollars back into your pocket by reducing them because of the investment strategy. So you end up paying, instead of, let's just use really round numbers, 50,000 in taxes on your income, you're only going to pay 20,000. So you're going to have $30,000 back in your pocket for taking advantage of these investment strategies. So we do have a strategic alliance partner that specializes in high wage earning investment strategies. The deadline for 2025 was November 30th. So you're going to be wanting to look at this strategy and implement it in 2026. But I recommend having a conversation immediately about what those opportunities are so that you can know how to put yourself ahead of it. There's also a health insurance benefit that puts money back in your pocket as an employer and reduces your employee's taxable liability. So it's a double dip. It's good for both sides. And there's also a utilities audits, and there's other types of strategies that can be implemented over the year so that you're paying the minimum amount of taxes or getting taxes that you've already paid or fees that you've already paid back in your pocket by rebates and refunds that are out there that you may not know about. So if that's something you'd like to do, is kind of investigate what are some of these investment strategies, reach out, let us know. We'll connect you with our strategic partner and we'll get you some savings. There's so many solutions out there that people don't realize just because they don't know what they don't know and they don't know the questions to ask. So I'm bringing this to you so you know now this is an option. Let's have a conversation and see if we can make something work. There's also nonprofit donation strategies that really help you help the community save on your taxes, and it's a win-win for everybody. So, and I'm talking not $50 donations or $100 donations. I'm talking larger investments in the local nonprofits, but in a way that puts money back in your pocket through tax savings, and then of course helps your charity of choice at the same time, which is never a bad thing. All right, the next one I'm going to talk about is entity selection, because you may be at a point where it will benefit you now to move from where you're at to another entity entirely. So that could look like going from an LLC to an S Corp elect. That could look like going from a sole proprietor to an LLC with or without the S Corp election. That could look like going from a sole proprietor to an S Corp proper. That could be creating a C Corp instead of functioning as what you are now. It's a lot of different things. There's not just one entity selection. I'm going to focus on the most popular, which is the S Corp, but of course, you need to have this conversation with a tax strategist to understand what the real best move for you is. I have seen too many times where somebody just followed a TikTok, or back in the day, it was an Instagram or Facebook reel, or followed some sort of influencer's influence. And it actually was not a good move for the business. And it ended up costing them more money because they didn't really talk to a professional about it. So be careful, because all of these things will be additional costs to you. You need to make sure that the tax savings they're providing exceeds what the additional cost to you is. And I'll take the most basic example of going from a single member LLC and then no tax election, which basically means you're still treated like a sole proprietor from a tax perspective, but you now have the liability protection or the asset protection, versus an LLC going to an S Corp elect. Just because you are an S Corp elect and not an S Corp proper doesn't mean you can circumvent the S Corp compliance regulations. As soon as you take that election, you are now functioning as an S Corp, period. So what that really means is that you have to follow the same rules as anybody that is just an S Corp, not an LLC. The only difference is on the asset protection side of things with an LLC once you do that. Some of those things are that once you move to an S Corp, elect or otherwise, you have to pay yourself on payroll, period. You cannot just take draws any longer. One of the benefits of that is that you are no longer paying the 24% or the 15, excuse me, percent additional tax on your profit every year. That goes away. So it's an immediate savings of 15% in taxes on your profit, because you're also then having to pay yourself your taxes. You're only paying what's legitimate income taxes, which you would have already done on your taxes, minus that 15% self-employment income, because you're paying into the Social Security and Medicare now through your payroll. That should only be done if at the end of every year you have more profit left over than you would have a reasonable compensation amount for. This amount is not just like pull it out of the sky, guesstimate, add add this, divide that. It is an actual analysis that is done and based on your location, your proficiency in the tasks that you do, the tasks that you do, the time that you spend in the file in your business, all of these things combined. It's about an hour to an hour and a half of sitting down and really answering these questions. What you're ultimately trying to accomplish is that what would you have to pay a person walking in off the street to actually do the job you are doing, not the theoretical job, the actual job you're doing. And we all know as business owners that we're wearing 47,000 different hats. We all know that employees do not think about our business the way we do, and it's not constantly on their mind. We know that nobody's worried in sales about how IT is doing, and nobody's worried in IT how sales is doing, and nobody's picking up the bathroom trash. We are. So, what would you have to pay somebody to come in and replace you? That is what is reasonable. And the analysis helps you figure all that out. And here's something you don't want to do. You don't want to just start saying, oh, I'm the CEO. I'm the CEO. You're not. I hope you're not, because CEOs make a lot of money, a lot of money. And so you're minimizing your salary to start in the hundreds of thousands of dollars a year range. That might not be reasonable, really, right? So you want to be as real as possible. If your proficiency is small, if your time amount is small, if you do this much here, but this much over here, we want to see those types of things so we can come up with actually reasonable, not just guesstimated. Why that matters is in a corporate audit, the IRS is going to look at what you're paying yourself and see if it was considered reasonable. When they say, where did you determine or how did you determine that this salary was reasonable? You will then have the exact backup, which is their exact analysis that they are going to do to present and say, this is why it's reasonable. And they are going to have to say, oh, you're right. Yep, that's what that says. Otherwise, they can determine, oh, you have way underpaid yourself. In fact, all these distributions you ended up taking are now needing to go onto payroll, and you owe all these back payroll taxes and the penalties and interest for not having filed the payroll taxes when they were initially due. So you don't want to put yourself in that position. All that to say that S Corp election can save you immediate 15% on taxes on your profit, but you want to make sure that you're doing it at the right time. You also then can still take advantage of the accountable plan spending plan, like we talked about before. So that reduces your corporation's taxable liability and make sure that you don't get taxed on your income side, on the income tax side personally. And there's other strategies in place where you can actually pay into your taxes through your payroll all year long, not have to do estimated, not have to pay over the minimum amount that's legally and ethical for you to pay. Base versus being just based on, okay, I made all this profit and now I owe an extra 15% on it. There are other tax strategies involved with corporations, which is why it is a strategy and why it is a good move for you at a certain point in time. So I encourage you to have that conversation. This is where my business is now. This is where we project to go this year. Should I make an entity selection that's different than what I'm in this year? Have that conversation ASAP. I am going to warn, though, that we are already in, oh my God, freak out, taxes are coming mode in the accounting world. And 1099s are due this month and W-2s are due this month. So you may have a little hard time finding somebody that can really sit down and focus with you. That's why I suggest finding a tax strategist and not just a tax preparer. That's also shuffling all these other end of the year type things around. Ideally, you're working with a professional all year long on a minimum of a quarterly basis to do check-ins, to understand what new things have come out, to give them scenarios so they can build out projections for you and work with you and strategize and put implementations in place before it's too late. Okay, next I want to talk about the OB3, one big beautiful bill. That is now officially out, and it is going to significantly change in a positive way several things for businesses. I'm not going to talk about the entire bill, the 400-page bill, and I'm only going to focus on the top three things that would apply to almost every business, even depending on or not depending on the industry. Again, not a tax professional. You want to talk to a tax professional, but I want to bring these to you so you know the words to use to ask about when you're having those conversations. We would all hope that our tax professional would come to us and say, based on the new updates of the one big beautiful bill, you're going to qualify for this, this, and this. I promise that does not happen. They are buried, they are busy, they are scrambling, they are probably understaffed. And while they do know the information because they have to keep up their knowledge base, it does not mean they're working on your behalf all the time. I am not putting anyone down. I am talking about every year what I see when I get customers or when we work with our customers and their taxpayer does nothing but input numbers and next and input numbers and next. Again, talking to someone who does tax planning and tax strategy is your key here. Bonus depreciation, the extended bonus depreciation of 100% upfront is going now to 2030. It had previously been sunsetted, I believe, in 2028. No, we're not even in 2028 yet, in 2018. And then it went to like 80% and so on. Anyway, they've brought it back to 2030, which means you may be able to take advantage of writing off your entire big purchase up front. This is only a good move if you're making a giant profit and you need a way to reduce the profit by writing this off, the depreciation. If you're making a small profit, don't do this because otherwise you're losing a multi-year depreciation opportunity, which might better benefit you from a tax perspective than taking it all up front. You don't want to take things up front if they're not going to keep benefiting you long term, strategy wise. The R&D credits have been extended through 2029. So you may be able to find some applicable R&D credits, that research and development that apply to your business and your industry that you can take advantage of, which again is a multi-year scenario on your taxes. And the qualified business income deduction is moving from 20% to 23%. So it's an additional 3% deduction that you can take on qualified business income. So those are the top three ways almost any and all business could potentially benefit from what we call OB3. I've also heard OBBB or One Big Beautiful Bill. I've heard a couple of different things, but OB3. So there's another tax strategy potential for you. Make sure you're asking about specifically how can I benefit from OB3? Make them really think about and strategize what this does for your tax return. Now, if they miss something, that doesn't mean that they're doing your taxes wrong from a tax perspective. It just means you're probably overpaying in taxes. So from a business perspective, it might be wrong, but from a tax planning or tax paying perspective, the government's going to be like, cool, they paid more taxes than they needed to if they had not taken advantage of this program. So I hope some of this was helpful, if not all of it, and it got your mind kind of working on ways you can legally and ethically reduce your tax liability as a business owner. We are going to do our second mini masterclass of this month next week. So we usually do them on the second and fourth Thursdays of the month. However, I am going on my first vacation in 10 years at the end of this month, and therefore will not be having mini masterclass the fourth Thursday of January. So we're going to have it next week on the 15th. And we're actually going to be talking to a local business owner who turned his business, his sinking ship business around specifically because he started taking advantage and using his numbers and starting to really understand what was going on. And so he attributes saving his business by actually really understanding his numbers at some point in time. And I want you to hear from his perspective as a business owner, not my perspective as an accounting professional, why your numbers really matter. So thank you again, everyone, for joining us or watching the replay. We'll post it as soon as it's live on our YouTube channel. We wish you all a very, very prosperous 2026, and we will see you at the next one. Bye.